Good evening, Jags. This is Fahad. I want to take a look at Micron, symbol MU, Micron. This is the chart right here. This is the annual chart. Large rounding bottom. It came down hard late last year, then did nothing, formed a very large base in early 2016, and now it's starting to move higher. Now, usually when I do these videos, I start with the chart and I throw the option activity and then I dive into the fundamentals. But in this particular case, I'm going to go with the fundamental view first to kind of show you the color of exactly what I'm looking at, and then I'm going to show you the rest of the stuff, the technicals and the option activity. So this is where it all started. Back on this is very recently. This is on August 9th, right here. I found this in my inbox. Somebody forwarded to me in the computer world, an article in the computer world, and basically talks about Micron ships samples of its first 3D NAND flash for mobile devices. Now, the most logical thing that came to my mind at the time was that there has been much chatter that Apple new iPhone 7 that's coming up in a couple of weeks, or a couple of months actually, sometime in the fall, is going to have a 3D NAND chip in it that's going to be built by Micron. It's been discussed ever since February. Whether iPhone will have it or not is yet to be seen, but that's actually the chatter. So first this article came, this was about August 9th. After that, something very interesting happened, and it was this note from Credit Suisse. Credit Suisse, there was a big giant conference called Flash Memory Summit. This is an annual Flash Memory Summit conference of 2016. And this happened in early August or mid-August, sometime around 12th of August. And so this article was published on August 14, and it really caught my attention. But even at the time, I did not care much about this. It's a very, very bullish article, but it takes much of a longer-term view. So I sort of put it aside and did not pay much attention to it. But now when I'm looking at it, it makes a lot of sense. In this case, on August 14, the discussions that came out of this conference was the NAND adoption accelerating in enterprise. Now, this is not the NAND adoption we're talking about in smartphones, which is most likely going to be the driver of the 3D chip. I'm talking about enterprise over here. This is something we rarely talk about, because a lot of the time we talk about NAND adoption in consumer devices such as smartphones or whatnot. But this is new. This is enterprise, and this takes Micron to a completely new level. Now, a lot of things discussed over here, but I'm just going to quickly go to the big bullet points that caught my attention. The first one is right here. The higher scalability and performance in a maturing ecosystem will accelerate the adoption of SSD enterprise cloud storage applications. And right here, driving overall NAND bit CAGR of 45% over the next 4 years versus consensus of 35%. So as soon as I read that, the first thing that occurs to my mind is, okay, there's a disconnect in the story. The consensus at 35% was already pretty bullish, and now coming out of this conference, which happened in early August, they're talking about this thing is going to be more like 45% growth over the next 4-year period. And so Credit Suisse highlighted 4 stocks that are going to take the major lion's share of it, are going to be the biggest beneficiary of it. One was the combination of Micron and Intel, which is powering the 3D NAND in the enterprise, and the second one would be Applied Material and Lam Research. Now, funny thing is, all 4 of these stocks are our favorites, or at least 3 of them that we have discussed in the past. We've discussed plenty of call activity in Intel. We know Lam Research, we made a big killing on this recently, and it's one of our favorite stocks, trades at a very low valuation. And recently we saw Applied Material posted a blockbuster quarter. So this all caught my attention, and then these are the charts. So this is the NAND adoption in enterprise. So cloud plus enterprise right here, and this is the chart you need to pay attention to. Basically, this is telling that we're going into an inflection point starting from 2016, where the memory, where the installation is increasing sharply, and it's just going to accelerate from here at a rapid pace for the next several years to come at 45% CAGR. And so this all caught my attention very much. But then I put this article aside. By the way, just to kind of show you real quick, 3D NAND is now mainstream, and the technology expected to represent majority of bit shipment for the industry by mid-17. Again, this applies entirely to Micron. Storage vendors indicated that they have access to 3D NAND from Samsung and Micron. And so Micron announced the introduction of 3D NAND, blah, blah, blah. It goes up into all this whole thing. So this really caught my attention, but it's a much more of a longer-term view until I saw this file today from Credit Suisse. Now, what the heck is this file? Let me just show you. This one is basically a daily edition from Credit Suisse that comes in my inbox every day. So this is from today, August 25th. This is the last edition, so I just got this 2 hours ago in my inbox, and usually it discusses a ton of stocks. So here's discussion Medtronic, Dollar General, and whatnot. I get this every single day after market close, and I usually, after dinner, I just sit down and go through this, and I try to find something that catches my attention. In this, if you scroll all the way down in today's file, you're going to see right here, the final discussion is on semiconductor devices. And so they discussed something over here that really caught my attention. Now, Hewlett-Packard, HPQ, recently announced earnings. And these were the major takeaways from Hewlett-Packard earnings that is indicating very, very strong demand and shortage at the same time in DRAM and NAND enterprise. So here, HPQ indicated that they are seeing some shortages of DRAM, NAND, and LCD due to increasing demand from non-PC market. Non-PC market means enterprise. The comments are the first major indication. This is the key here. The comments are the first major indication from the memory customers that there are developing shortage of PC DRAM. HPQ highlighted that the increasing memory demand due to content growth in mobile as a reason for developing supply shortage. We believe the comments support our view that the DRAM and ND markets are likely to be undersupplied, this is key here, undersupplied in the second half of 2016. And then it goes to show, we believe the commentary is positive for memory and semicap companies. Now, right here is the key. The comments are also supported of our view that Micron's August quarter and November quarter EPS could upside to 8 cents, 28 cents versus street expectations of 18 cents and 3 cents, as DRM prices could remain flat. And right here, Micron could gain market share of NAND in high smartphones. And I will show you one thing right here. This is the line. Where did it go? Right here. We estimate that Micron August quarter EPS is tracking at 5 to 10 cents loss above the street estimate of 18 to 20 cents loss, and see potential that for the November quarter EPS to be 25 to 30 cents positive. That's not a negative number. 25 to 30 cents growth versus street estimates of 3 cents loss. I mean, the delta here is huge. It's gigantic. So for the November quarter, for example, on the August quarter, which by the way is coming up, and late September is when company is going to announce earnings. That is Micron about a month from now. The consensus is sitting at 18 to 20 cents loss. And the commentary that's coming out from Hewlett-Packard as well as the Flash Summit that happened on August 14 suggests that Credit Suisse is making a case that the August quarter, which is going to be announced late September, is tracking at 10 to 5 cents loss versus 18 to 20 cents loss. So that's a huge delta. That's basically the double of or half the loss that the consensus is estimating. And the November quarter, they're expecting a huge delta of 25 to 30 cents profit versus a 3 cents loss that the consensus is estimating. I mean, if you look at these numbers, then it starts to make sense. So let me put it in this way. If I go over here, let me just pull this up quick. This is from TD Ameritrade. So if I just blow this screen up a little bit, you'll see this is the annual, and you see how Micron EPS estimates have been coming down for a long time because there was an oversupply for a long, long time. So estimates have been cut and cut and cut. Now, if I go to the right here earnings analysis, you'll see how in the quarterly analysis, the consensus, which for Q4 right here, see, this is going to be ending on Q4 period ending August 2016, which will be announced in late September. The consensus is expecting a loss of 17 cents. That's the consensus right now. They're expecting a loss of 17 cents. And then the following quarter, which is the November quarter that's going to end, they're expecting a profit of 2 cents. All right? But in this file, the Credit Suisse is making case that the loss is not going to be 17 cents, going to be between 5 and 10 cents, and the November quarter is going to be extremely robust with a 25 to 30 cents profit. Now, if I start extrapolating this, removing some seasonalities and whatnot, a 25 to 30 cents times 4, that equates to an annual EPS of approximately $1 per share, which spits out a forward earnings multiple of 16 times earning, with stock trading at about $16 a share. Compare that to where the annual consensus is currently, it's at 52 cents. I mean, the point I'm trying to say is that is the consensus really so out of line that literally the commentary that's coming out in the last couple of weeks is going to suggest that Micron is going to earn double or maybe even more, double of what the consensus is saying. If that's going to happen, I don't think you're going to see the stock where it's at trading right now. I think you're going to see this much higher than where it's at right now. Now, I understand it has run up a little bit, but you're going to see much higher. Now, by the way, Credit Suisse wasn't the only one. I think a lot of different analysts have started to notice the change in character, so I just want to tell you something real quick. On August 25th, which is today, but this morning, Nomura raised the price target to $20 and increased the margin expansion target on the stock. Also, Mizuho Securities this morning, that's the second analyst, talked about DRAM shortage and raised the price targets on the earnings estimates. Go back 3 days ago, on August 22nd, Mizuho raised the gross margin target 3 days ago as well. Go back further, Needham on August 19, which was last week on Friday, Needham raised the price target and provided very bullish commentary after the Korean vendors scrapped the wafer agreement they had with Apple. Go back further, August 16, that's also last week, Breen Capital raised the price target to $18 per share and reiterated buy based on the same logic. So I just counted, I can just go further. MKM Partners, August 15 as well. And you can just go further back down. Nomura also on August 4. I'm just looking at a different screen here, by the way. Basically, at least 6 analysts in just the last couple of days have come out, and they have raised the price targets because they're all starting to see the change in character over here. So we got extremely bullish. I think there's a major disconnect in the story over here. If Credit Suisse is even half right about their forward earnings estimates, that is still implies as much as 50% upside, if not 100%, then 50% upside in the forward earnings estimates. And so I think that when the next 2 quarters earnings reports come out, the people are going to realize it, and the consensus is going to move higher, and you're going to see the stock is going to be trading much higher by that time or whatnot. So that's all on the fundamental side of the things. Now on the option activity side. Now I'm going to go through one by one. Micron generally has very, very liquid options. It trades a ton of calls, but I'm going to show you something that caught my attention. So in the option chain, go to the last week, which is September 30th. Now, by the way, before you look at that, I just want to mention that Micron, going back to this chart, see this question mark right here? Micron right here is expected to report earnings on September 29. Write this date down, September 29. All right? Now, going back to the option chain, the last week, the weekly options in September, which expires on September 30th, all right, you'll see this 13,000 open interest right here at the 16.5 strike. If I click here, click here, click here, and increase that, and you'll see this big spike on August 15 right here. That's when they bought those calls. Let me show you what happened at the time. Let me see, where did my screen go? Right here. So it happened on August 15 at the September 30th weekly. So right here. Right here is the snapshot of that. So they came out at 10 o'clock in the morning, and then throughout later in the day, I'm just scanning for only 100 size lots on this. This is September 30th weekly 16.5 strike calls on August 15, and they bought 18,000 of these contracts. 18,000 of these contracts, and they were paying about 62, 63, 64, 65, all the way up to 70 cents offer side. All right, they paid about 70 cents. That's approximately $1.1 million bullish bet. And it was positioned using a weekly options, which is exactly in the week in which the company will be announcing earnings. So this is specifically an earnings play, about $1.1 million bullish bet that is positioned right over here in the September 30th weekly 16.5 strike calls. But let's not just only look at that. I went back and looked at a lot of other historical data. So I'm going to start off. I'm going to go to leap options, all right? Now, see this go all the way out to January 18, and you're going to see something very interesting. Go to January 18, way out there, and look at this 15 strike calls, which has 36,000 open interest. If I expand this, you're going to notice that right here, that there was a bulk of call buying, and I saw all of this. I went back and checked that they were indeed bought. So, just take my word for it. But this happened around June 8th. A huge bunch of blocks of calls were bought on June 8th. This is January 18, 15 strike calls. All right. Now look at January 18th, further deep in the money, 10 strike calls. Right here, go over here, extrapolate this. You're going to see the same picture. Right here around June 8th. Huge spike in, by the way, this blue line. Let me just get rid of the theoretical price section so I'm not confusing you. This blue line is the open interest. See this big giant bar? Now this time we were talking about January 18, 10 strike calls. Huge spike and big amounts of calls were bought. All right, this was also on early June. Go back to this. Now go to January 17, 20 strike call, which is 103,000 open interest. You're going to see something similar here. Actually, not this one. This was right here, the 79,000 one. This is the January 17. This is the January 17, 15 strike call with 79,000 open interest. So let's open this, and you'll see the same thing over here. See this? This is on June 2nd. Again, in early June, big spike in the money call buying in January 17. The open interest spiked higher big time that time. All right. Now let's go to December 15 strike call. Right here. You're going to see exactly the same thing that happened there as well. Right here. See this? This time happened in July. This one, because this was not, the month was not available, December month until June started. So you'll see the volume here. You'll see the same thing over here. This happened around late July. Big spike in open interest. They were buying December 15 calls. The point I'm trying to say, and you can see, by the way, if you look at the November 14 strike, you'll see the same thing. So November 14, December 15, January 17, 15 strike calls, and January 18, 10 strike calls, and January 18, 15 strike calls. All of this massive call option activity has been taking place in the stock. All started. Let me pull up the Micron chart. All started around mid-June, which is right over here. This is where it started. So the company reported earnings, and after that, it all started right around mid-June, and the stock is off to races since then. Massive options call accumulation in short-term and long-term. The chart is starting to run higher. And we got the bullish picture being presented from HPQ earnings, from Lam Research, from the Flash Summit that happened in early August, and the most recent analysis that was provided by Credit Suisse. Now, with all of this said, here is my only little problem with Micron. This daily chart looks fantastic, and it's been making higher highs and higher lows, and I think it can go climb higher to all the way to $20 per share. But when I look at the weekly chart, which is right over here, you're going to see a little problem. The stock is starting to face a little bit of trouble right around already where it's at right now. There's big volume of price congestion area that's coming up around $17 a share, and the stock is almost here. So it's going to have a little bit of trouble. The stock is going to have a little bit of trouble trying to cross this congestion area. There are a lot of dead bodies in this that are sitting here all the way going back to last year that won their money backs, and there will be sellers here. So at a minimum, the stock, after running up as much as it has already has, most likely it's going to pause here before it breaks out again. So it wouldn't surprise me with earnings coming out on September 29. There's a whole month here between now and September 29 that the stock is going to likely pause here and just consolidate for a couple of weeks. And then when the earnings come out, it's going to blast higher. And if that happens, it's going to open up into this big air pocket that comes up right here. And you're going to see this march higher all the way to $22 and maybe as high as $24 to $25 a share. So we're talking some significant upside over here. I mean, on a $16 stock going to 22, you're talking, $6 of upside, which is as much as 37%. Let me show the same technical picture in a different way. So this is from stockcharts.com. This is so you can see, that it's been running higher and running higher. And let me put it this way: I can do a quick technical study over here, and I can just draw the line right here. So you can just connect the dot. It is possible, it comes up to trend support and bounce, trend support and bounce, trend support and bounce. Maybe it will come back to trend support again between now and September 29 and then bounce and take a new leg higher. If that happens, you want to be buyer of the stock on that particular pullback. All right? But on other way of looking at this is the weekly chart. So this is what I was going to show you. If I go here and look at the long-term weekly chart right here. So see this? It's going to come up to some major congestion area. It still has some room to run, but between 17 and 18, it has room to run. So you could probably still see some further upside, but then it's going to stall. It's going to be some congestion area. But if it breaks out over here through $18 decisively, and it's going to probably require very good earnings and guidance to do that, I think you're going to see this thing break out and make a run all the way towards as high as $25 level, which is right here. So that's what I'm talking about. So there's a big air pocket that's coming up. That's what I'm looking at. Another way of looking at this, you can just draw this right here, but it's a long time ago it broke out from this, now starting to run higher. Look at RSI very hot, look at MACD very hot, look at the volume profile is starting to rise. So it's got all the technical pictures, all the technical momentums lining up behind this. So that's with all of this. So we got a bullish picture, maybe some pause and then further up higher. We got a really beautiful fundamental picture that's laying out in front of us, which tells us that the forward consensus view is probably as much as 100%, under than what the real numbers are going to look like down the road. And we got extremely bullish call activity taking place for a long time. So how will I trade this? Now I'm going to keep this very, very simple. I'm going to make this strictly an earnings play. Okay? Yes, you can go out to October, November, December. I'm going to make this strictly an earnings play. And I'm going to keep it very simple. I'm going to go straight out to this last week of September. All right? Last week of September. And actually, no, not the last week of September. I'm going to go out to the first week of October, which is right here. This is going to be the expiration, October. Let me just show you real quick. We're talking October 7th is the expiration, October 7th. So don't forget that. We're going to go out to October 7th expiration, and we're going to buy straight 16.5 strike calls, which is slightly out of the money. We stock at 16.20. and we're going to pay about 95 cents for it. The bid and ask is 88 and 95 cents for it. Basically, I want to capture the earnings that are going to be in late September. But because the company has not yet confirmed the earnings date yet, it is possible that the earnings may slip to the following week, which is why I want to go to the first week of October. I want to buy straight 16.5 strike calls that are expiring on October 7th. Now, you might be wondering, why am I recommending buying straight calls? Why not do some sort of spreads, which is a question I often get asked. So let me just explain something real quick. The time you want to buy the spread is when you have a very, very good view on the implied volatility versus the difference between the historic volatility and the implied volatility. When there's a big difference between the historic volatility and the implied volatility, that's when it makes the most sense to buy spreads. We don't have that. And let me show you a picture that will show you that exactly what I'm talking about. This is live vol right here, and here is where I'm looking at the implied volatility difference. See this? This is HV, HV60, and IV60. This is the difference between historic volatility, implied volatility. And the blue, focus on these blue lines and the yellow lines, and they're basically flat with very minor difference. Another way of looking at it is just look at the difference. This yellow line right here is the difference between them, and it's nearly at zero, which means the historic volatility and the implied volatility both are essentially at the same level. And when you have that, which means you don't really have an incentive to do a spread, such as calendar spread or a vertical spread, you're better off just buying straight calls. Another way of looking at it is by looking at individual implied volatility. So you look at this, focus this on closely. So as you go into September, here's the implied volatility line. Notice it's 40%. It goes to 45%. And then 45, 45, 45. Go any month, 45, 45, 45. You can go all the way out from September all the way out to January 18, 2018, and it's the same implied volatility, about 42 to 45%. It's not much off. It's about the same. When you don't have that differential, you don't have an incentive to do a spread. You're better off just buying a straight call. So that's why I'm recommending, again, just to close it out, it's a long freaking video now. The best way to trade this is just capture the earnings, go straight out to the first week of October, which is October 7 expiration, and buy 16.5 strike calls for 95 cents or less. All right? That's it.